Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Hello, everybody. This is Harold Green of Brightree, and it is time to stop doing what you hate. Hopefully, you are having a fantastic day today. Doing pretty good. Just kind of had some things on my mind that I've been thinking about lately. And, I've been kind of sharing some things with some people. A lot of stuff going on in the world right now. And I don't know where you stand politically on anything, but I just really want to share with you some things you can do to protect yourself, because things are going to get very interesting in the next 10 years, if you ask me. But overall, I've had a pretty good week. Had some people come out to Las Vegas to hang out and, do some business and things like that. So it's been pretty cool getting caught up or whatnot. And but it's also been a very crazy week in regards to the stock market. And by the way, we're going to be talking about investing today. So I'm going to put this out there ahead of time. All investments do carry risk of loss. Past performance is no indicator of future results. So before you do any investing, make sure you understand your risk tolerance, your time horizons, and then invest carefully. Also, make sure you create a well-balanced, comprehensive financial plan that encompasses all your goals. So that way you can create an investment strategy around that and make sure you're getting a couple of different opinions about the investment strategy. If you're going to be doing it yourself, that's one thing. If you're going to be working with a professional, make sure you understand what's going on that side as well. But it was a very bad Monday in the stock market, and it was about $1 billion of individual money coming out of the stock market, just regular investors selling off left and right. But the institutional investors, kind of like myself and other firms and people that do this for a living, went in and bought up $10 billion of those assets that the regular investors dumped, because it was just bad. And so today's show, I want to talk to you about something very important, and I'm going to title today's show America's Investment Crisis. And I'm not going to say a lot today, but I think I'm going to say some very important things. And I've had to kind of humble myself in regards to how I want to talk to you folks about this. And I'm going to hit you with a lot of facts first, and then I'm going to kind of get into some solutions and some things that you folks I really want you to be aware of what's going to be happening over the next 10 years. And a lot of people say, well, if someone had told me this a long time ago, I would have been better prepared. Well, that's like saying the news channel says a hurricane is coming and you do nothing about it and your house gets blown down, and you say, well, if the news would have said the storm is coming. Yeah, I heard that before. And I think a lot of people hear information, but they're just either unwilling to act on what they believe or what they hear, or they don't believe what they hear, or they don't care. And we're in this crisis because of a number of different reasons. Either people, they don't know, they do know, or they know and they don't care. And it's not supposed to be your responsibility to take care of people when they've made very bad decisions in their life. Okay. And I want to be humble about this and just kind of share this show with you and give you some ideas on what you can do to insulate and protect yourself. Are you ready? 1, 2, 3, let's get it. The number of workers age 75 or older will double over the next 10 years. Let that sink in. The number of workers age 75 or older will double over the next 10 years. You're going to have 90-year-olds at Walmart trying to go out there and get carts and stuff. Like, let this sink in. More than 25% of older people will get 90% of their income from Social Security. Like, let that sink in. Social Security is expected to run out by 2030 to 2040. If you've been paying into Social Security, it's expected to run out. Like, let that sink in. And over the last 20 years, all the politicians have known that. And I got to be careful what I'm about to say, because I don't want to end up on some kind of watch list. I don't want people following me around. My goal is to help get as many people as I possibly can from the 97% to the 3%. And 97% of the people in this country retire with not enough to live on that will last them their entire lives. They just won't have enough. That's a fact. And this is only getting worse by the data that I can see. Okay. No, they all know the Social Security is going to run out someday. And what are the proposals that are on the table right now to fix Social Security? Have you guys heard anything about what's being done to fix Social Security? Absolutely nothing. But I'm a thinking man. And here's what I thought, that if I was in charge, here is what I would do to fix Social Security. I would allow as many people into this country to work as I possibly can in order for them to start collecting paychecks and helping to pay into the Social Security system. Young people, like I would allow as many young people as I can. Here's why: the birth rate in America is dropping left and right. We have to start importing our workers now because the birth rate is dropping and we don't have enough people in the workforce to help pay into Social Security to support the system. People, we are dealing with a disaster. Now, I'm not saying that's the right thing to do, but when I look at it, it's like, okay, why are so many people being allowed into our country? Like, it started to make sense to me because I look at Japan, and Japan is in the same situation. Their birth rate has dropped drastically because young people have lost hope in the American dream, or just like in the dream period, right? A lot of people have lost hope. So now we're resorting to a lot of different things. 68% of people who work in the private sector, like have private jobs, have access to a 401k, but only 50% of the people who have access to 401ks use them. And only 44% of Americans can afford an emergency expense of $1,000 or more from their savings. People, this system we are currently in is creating a large working class and a very small ruling class. The gap between the haves and the have not, it's growing and growing and growing. And about 25% of seniors are living on less than $15,000 a year. Now, here's the problem. If you say, like, Harold, like, this is not my problem, it means you're not fully aware of the situation. Like, you don't have any situational awareness, right? You have no idea what's going on. You've stuck your head in the sand and you say, I have enough. I got like 4 or 5 million bucks. Yo, I'm good. I don't have to worry about this. Like, that's their problem. Now, according to Pew, the taxpayer is going to have to bail out people who didn't save for retirement. And I quote what they said. And insufficient retirement savings hurt not only workers, taxpayers also pay a price. The Pew study found that inadequate retirement savings will significantly affect every state and the federal government over the next 20 years, resulting in a combined 1 trillion increase in public assistance cost. They're going to have to raise your taxes in order to bail people out who didn't save for themselves. They're telling you that ahead of time. This is just guaranteeing you're going to be paying more taxes in the future, a lot more taxes in the future. So my question to you is this: does your financial plan have a mechanism which allows you to, number one, reduce the impact of high taxes and inflation on your income assets in the future, right? Do you? Do you have something like that? And number two, if you don't, why not? And I believe in having assets across all spectrums and things that, like, if something were to go bad, where will the government go first to get money? Okay. First of all, the easiest thing is to raise taxes, right? Number two, they look at assets that haven't been taxed yet, and then maybe try to go after those assets that haven't been taxed yet. And then number three, they go after assets that have been taxed, like maybe long-term capital gains and things like that, or short-term capital gains, or whatever. I think there's just an order of where they would kind of go to first. And the reason why is because it's political consequences to them. Nobody really wants to raise taxes to bail out, another, group of people. However, if they can gaslight you into thinking that there is more of you that don't have than those who do have, then yeah, they can get away with like voting to raise taxes because they'll be able to stay in power because they've kind of hoodwinked those people who don't have into thinking that, yeah, we're going to take from these guys and give it to you. And again, I'm not trying to get on a no-fly list or anything like that, all right? Or any kind of watch list, right? I'm just stating what I see, and I'm just simply stating the obvious because we want to get more people out of the 97 to the 3. And what I do is I use dividend paying whole life insurance in my base of my financial plan and my foundation, because a dividend paying whole life insurance contract is a unilateral contract between you and the insurance company. The federal government cannot void a contract between you and a life insurance company, but for one and one reason only: it is because of a failure to pay some taxes on something. Like if you don't pay your income tax, there could be like a lien on your house or something like that. That they could put a lien on your life insurance policy. And that's the only situation where I've seen that any state or any municipality has any control to be able to come in and do anything to your life insurance policy. And I think that's a very, very sound thing because it's the only thing I've seen, not even bank accounts. Not, I mean, it's insane. And I think that a lot of political people are running on these issues, but with no real solutions, just band-aids. And for that, there's a lot of back patting going around, hand high fiving each other. For example, they came out with something called the auto enroll IRA program, and it's been mandated in a number of states. But my question is do these mandated programs really work? So the Pew says these state programs work. Like they're like, these things work, right? Over 800,000 savers in 7 states with active programs have amassed more than 1 billion in assets since 2017. This stuff works. Now, remember I said like 44% of Americans can afford an emergency expense of over $1,000 or more from savings. When we add up this program that works, the average person has $1,250 in these accounts. And that's from 2017 and we're in 20. That's 7 years. That's how well these programs are working. Now, I'm not saying they should not have tried, but I'm saying if you're going to do something, like you got to be getting better results than just saying, hey, these things work and we did something about it. Now, I'm going to give you some numbers. Like, and in terms of saving for retirement, this is what I found in the research, right? If we look at an age range of people with average balances and then median balances, this is what we're going to find. And people that are 25 to 34 have an average balance of about $37,000. And the median balance is like 14, like half, more than half of that, or less than half of that. And the age group of 35 to 44 is 91,281, and the median balance is 35,537. Okay. And like, this is when you're just settling in, you're having kids, and you're like, trying to get stuff done. Maybe have a kid going off to college. You got a mortgage going on. Like right now is one of the worst times for these families because things are costing more and they can't put away as much. Inflation is a disaster to everyone, okay, except the rich because they can afford inflation. It doesn't affect them. They're getting 5% on billions of dollars in high yield savings accounts. Like the average American has less than $1,000, right? So again, this is some serious stuff. Age range of 45 to 54. Average balance, 168,646. Median balance, 60,763. Not good. All right. Because you 10 years out from retirement and you got like $168,000 saved and you 10 years out from retirement. Man, this is not looking good. Again, the people age 75 or older in the workforce is going to double over the next 10 years. This is why. Age 55 to 64. Average balance, $244,000. That's better, but the median balance is only $87,571. So, dog, man, you right there. You about to retire, and let's say you're 64 and you got $244,000. You're gonna run out in like 3 or 4 years, depending on where you live, right? Unless you're starting getting some phenomenal returns in your 401 in your IRA balance, which most people are not. They're probably seeing 5, maybe 10% if they're lucky. And here's the question, and this is a very serious question I want you to think about. Over the last 10 years, the Vanguard S&P ETF, ticker symbol VOO, is up 176.48% total. The expense ratio on that is 0.03. That means like 3%. So you're up 173%. If that's the case, then why are the average and median balances in 401k so low? If there's been this great performance in the stock market over the last 10 years, what the hell is going on with everybody's stuff? It just blows my mind when I'm looking at this. And by the way, Apple is up 812% of the same time period over the last 10 years. Like from today, going back 10 years, Apple's up 812, BOO is up 176, 173 minus expenses. Okay. Here's the thing about people's 401ks. They have absolutely little to no idea on how to invest the funds. Absolutely none. There is no class at work about how to invest your 401k. None at all. Japanese say nanimunai, nai desu. Nothing. Okay. Many of them also have limited investment choices in the 401k due to the employers. Like they try to cut down on costs and also liability to the employer if something goes wrong in the plan. So the more aggressive positions you have in the 401k, The employer is the fiduciary at that point because they offered this thing to you and now they're responsible for it. And so if it goes bad and you lose all your money in the 401k, you can actually sue your employer for that because they put bad investment choices in your 401k. So a lot of 401k companies are, a lot of people are just leery as to employers are like, hey, many plans don't allow people to trade stocks in the portfolio just due to the volatility in the market and also the lack of discipline that's displayed by many what we call non-institutional investors. And employers also want, they want you at your desk working and not day trading your account. And some of the 401ks I've seen, they also have limited number of trades you can make during a single time period. And so I have another question because I'm like full of questions today. And as of December, December 23, there is about 7.4 trillion in 401k accounts. Now, with a management fee of about 1%, that's roughly $74 billion. Now, I'm not against anyone paying fees. Okay. Let's just say the fee is 0.5%. That's 37 billion. Why are people so underprepared for retirement and underinvested in their portfolios? I mean, I can't say it's for lack of professional management because people are picking funds that are professionally managed in their 401ks. These guys get paid a lot of money to manage these funds. The problem is the wrong funds are offered and the wrong funds are picked. And it's hard. So as an individual, if you find yourself in one of these age brackets with the amount of money that I'm talking about, you may have a little bit more, you may have a little bit less. It just kind of depends on your earnings level. Okay. Some people earn a lot of money and they still don't have anything saved because they don't understand how to properly, how to run their lives. And that's hard. Okay. So if you're listening to me like, Harold, what can I do? I'm gonna put this out there very simple to you. So I think the first thing you need to do is sit down and analyze every single fund being offered by your employer. You got to find out three things. Number one, the past performance of that fund. Okay. Find out the top holdings of that fund. And then you research the top holdings in that fund. The next thing you need to do is do a risk tolerance assessment that's going to allow you to plug in the best performing funds that you see that you have, and then see what the risk tolerance is and see if like your risk aligns with that fund's risk. And so if you're a high risk individual after you do your assessment and the funds you're in are low risk, then it just kind of tells you right there, you need to redo your selection in your 401k. The third thing I think you ought to do, and this is important, you got to sit down and redo your cash flow and your net worth analysis to see if there's any additional funds that you can invest in your plan if it's a great plan. Now, depending on your situation, you might be able to leverage some things to bring down your monthly personal outflows, which I think will allow you to invest more in your retirement plan. So if you can get your daily life like cheaper by leverage, like, using credit or using debt, using home equity lines of credit to do things and reduce your cost for life on a longer time frame horizon and take that extra money and invest it, because I'm telling you, if you're a young person, this is something you ought to be doing every day. If you are working with I would say a planner for sure, to make sure it's in a controlled environment. I believe all financial investing or anything you do ought to be in a controlled environment. Like when you do a controlled burn to like burn the brush and things like that to thin out your forest, it has to be done in a controlled environment. Many people are trying to invest outside of a financial plan. There is no controlled environment. The plan is the environment. You must create one. And number four, if your options in the 401k are too limited, I'm going to say look into opening an outside IRA or Roth IRA or a brokerage account, and then max out what you're putting in those things versus maxing out your 401k. I'm going to put it to you like this. In this situation, it's much better to forego the match due to the cost of the match. And I'm going to explain to you like this. If your employer is giving you 3% and you're barely putting in 3% yourself, and you have limited investment choices, how far do you think we're actually going to go? Why do you think we have a retirement crisis in America? Like, why do you think that is? I'm outlining it to you right here. And I can run some scenarios for you that's going to blow this match idea out of the water. But here's the issue that we run into. It's like a cultural gravity kind of thing. The match, in essence, it's what's trapping people inside bad 401ks. It's one of the main reasons why people are underfunded for their retirement, because they're stuck in bad situations. People are being told, you are stupid if you don't take the match. You're stupid. That's free money. You don't ever give up free money. And people are also being told that their 401ks have lower fees. that than investing in, with an outside professional or money manager. Yes, my fee starts off at 2.41%. But thankfully, I've been so incredibly blessed because we work so incredibly hard that we don't have clients at this point having to go back to work because we're not creating the income in their retirement plans that they need. I haven't had anybody over the last 10, 15 years tell me anything like that. Harold, I just got to go back to work, because you just ain't making me no money. Haven't had that happen. And again, this system that people are in right now, they're creating a large working/poor class, a small ruling class, and an even ever shrinking middle class. And you have to wake up and start protecting yourself. And the reason why people drink the Kool-Aid is because it's sweet. The only thing you get from sugary drinks over time are cavities. And this is exactly my point. We have a crisis in this country because a lot of people have drank the financial Kool-Aid and their financial futures, like they're full of holes, they're full of cavities. There's, as in Hawaii, hole is the word puka. There's pukas everywhere. Where I got pukas, he got pukas everywhere. Holes all in his clothes, in his shoes, pukas everywhere. And I don't want you to have pukas in your financial future. So if you're in the 97% and you want to get to 3%, I want you to get in contact with me and let's take a look at your situation. Now, I do have investment minimums. I do. And the reason why I have investment minimums is because I spend a lot of time and a lot of effort working inside of your situation to do my best to make sure you're going to be in the 3%. Now, sometimes I do take on people that have less than my minimum, but those are rare occasions, but some people do qualify for that. And if I do talk to you, I'll explain to you what your situation has to be in order for you to qualify to work with me without having my minimum. So take to heart everything I'm saying to you today. Do your own due diligence, do your own research. And if you know what, if you just can't figure it out and you need someone to help you create a controlled environment in which you are willing to work, I think we might be a good fit. So thank you very much for tuning in today and letting me share the things that are in my heart with you, my research things that I found, because I know we have to do something. And until next time, everybody, 1, 2, 3, let's get it.
This is thepodcastfactory.com.